Over the past year, we've watched inflation rise to its highest levels in 4 decades, with all areas of the consumer price index rising sharply. But as Isaac Newton famously declared, what goes up must come down, leading many to ask, when will inflation peak, and how can investors be best prepared to take advantage of the market environment when it does? My name is Anu Rajakumar, and today I'll be discussing inflation implications with some of Neuberger Berman's market experts, Olumide Owolabi, Portfolio Manager for Global Fixed Income, and Raheel Siddiqui, Senior Investment Strategist for Global Equities. Olumide and Raheel, thank you for joining me today.
Thank you.
Great to be here, Anu.
Now, as we all know, so much has been said about inflation. It's probably the most discussed topic amongst investors, causing confusion and anxiety at times. Why don't we get started by just taking a step back and framing the inflation debate as it is today?
I think the first point is what you made. Anxiety is going to persist because the uncertainty around inflation is going to persist. For us, one of the things we do is try to look at the sectors of inflation that are more critical. And we focus on 5 basic sectors, looking at food, energy, core goods, shelter, as well as services ex-shelter. When you look at the inflation measure, those are the places where you get inflation, more especially for the US. Food and energy, they kind of similar dynamics. There's geopolitical dynamics for that. And you have the greenization of energy, which fits into food also. And there's a supply-demand imbalance in there. You move on to core goods, definitely supply chain. And I think that's where you heard the word transitory all of last year. And that is beginning to change focus. And then you look at shelter, which is like 32% of the inflation measure. The non-affordability of house ownership is going to continue to feed that sector. And lastly, services. All of the fiscal transfers that you're seeing, they're coming to the forefront. And it's going to also be led by strengthening in wages, which obviously we're beginning to see in this era. You had all of that together. I think we kind of call it more of a bottoms-up approach to be able to get an insight into inflation. All that being said, what does that tell us? That inflation, though, is going to come down from where it is right now, but it's certainly not a higher level than the target of the central bank, i.e. the Fed. So, those sectors, those are the things we focus on to get the main drivers of inflation going forward.
I think a lot of the anxiety is around Fed's reaction to inflation. And so there are many measures of inflation that are published by a variety of Feds, CPI, core CPI, trim mean, etc. To understand Fed's reaction function, we feel the most useful version of CPI is published by Atlanta Fed. It's called sticky versus flexible inflation. We think it's like a more modernized take on core versus non-core inflation. Sticky inflation is very slow moving. It is related to the supply-demand imbalances in the labor market and embeds future inflation expectations. Flexible inflation is mostly goods inflation, is things that move up and down a lot based on what's going on in the goods market, oil prices, used cars, and things like that. Sticky inflation is more contractual stuff, your rents, house insurance, automobile insurance, medical care, etc. And you pay up more for these things if you think your income can keep up with it. So it's, inflation expectation. Going forward, unless you see a believable decline in sticky inflation, Fed is going to take that as a sign that labor market is still too hot and continue to tighten, even though the pace of tightening could change. So we would suggest that the right way of looking at inflation at the index level going forward to understand is to look at sticky inflation versus flexible. This data is available the same day as CPI comes out at 11 a.m. Eastern Time from Atlanta Fed.
Terrific. I will put it in my calendar. Thank you. Olumide, you mentioned inflation is going to come down, and Raheel, you mentioned a couple of different ways that you like to look at inflation. So with that in mind, what are the catalysts you think are required to see a shift in the policy environment to see that change in inflation? Maybe Olumide, you first.
if you kind of look back to what I said earlier in terms of de-aggregating inflation into those five sectors, you look at the drivers of those five sectors. Food, energy, goods. There is a certain statement that ties all of them together. You have to see supply-demand normalization for those different drivers. So that is the one place the catalyst for inflation to take it down. Within goods, it's going to bring it down. Energy is going to remain tug and pull. There's volatility in that sector, but ultimately a little bit higher due to geopolitical risk. And then food, the same thing. Now, the other part that you have to be looking at as a catalyst becomes the wages. The labor market. It's been very tight. So the services sector, as well as share as an element of that. And I think that's where you begin to hear experts bring in the dynamics of the Phillips curve analysis, driven by wages. If wages continue to strengthen, I think that continues to fuel services inflation. Those are the two key things that we're paying attention to. Obviously, third part and the biggest part is going to be the central bank, the policy making. Central banks definitely over the years, what they've done is raise interest rate, the Fed funds rate, as it's called, above the level of inflation to be able to get to a target. So those three things, if you pay attention to it, I think ultimately decides the fate of inflation as we go further.
Let's step back and think about what is the point of bringing inflation down to 2%. I mean, there is this concept of price stability, but there's a huge cost associated with it. Lots of job losses, potential recession, economic output. Why is this 2% so important? Today, we are having one of the worst episodes of real income growth. If you divide America into two, the upper half and the lower half depends almost exclusively on their income for spending. The upper half has wealth and they use wealth and income. If your real income is growing at a negative rate, you go to work every day and you get poorer. This is not a sustainable situation. At the end of the day, Fed is successful if we can turn real income growth for majority of Americans to positive. So you go to work, you earn a living that helps you power your spending and save a little bit. If we don't achieve that objective, there's a lot of talk about can go to 5% and stop. If real income growth, which is if we stopped hypothetically at 5% inflation, income has to be growing at more than 5%. That's, to me, the most important lens in which to look at this inflation issue. Is there enough tightening in the system to bring down inflation enough relative to incomes to turn real income positive? If that doesn't happen, the problem persists. And whatever the cost of recession is, the social cost of that negative real income is that much higher.
Now, that's interesting. One thing I wanted to ask about was how inflation compares to the 1970s, which lots of people have been talking about. But I actually also want to pick up on what you said about real income needing to be positive, Raheel. And like in the 70s, for example, was real income also negative in that period? And how do we get out of that? So the big question is really compare inflation with what was experienced in the 1970s. But if you can draw in some of the comments about real income as well, I think that would be helpful for our listeners.
Yeah, real income growth has never been more negative in the history of the data that we have than today. That's how challenging the situation is. There are lots of similarities with the 70s. Inflation expectations were elevated then, they're elevated now. That was the last great period of high inflation. There's one key difference between the 1970s and now is the source of inflation. In 1970s, interest rates were too low relative to economic growth. That led to a lot of credit growth, and that led to more money than the economy needed, which led to inflation. The recipe was simple. It doesn't mean it was easy to implement, but conceptually it was simple. You raise interest rate, rein in lending, and you bring down inflation. This time, the situation is not there's excess lending that's driving inflation. It's a lot of money sitting on the sidelines with the consumer. That is the problem. U.S. consumers have $1.6 trillion of just cash that shouldn't have been there without COVID stimulus. It's not the total cash. Total cash is about 18 trillion. This is 1.6 trillion that shouldn't be there. The wealth effect is like 15 trillion excess wealth that shouldn't be there without COVID. That is powering. Now, how do you use interest rates to rein in this money that's sitting in people's checking account? So interest rates are effective but inefficient ways of reining in this inflation. That's why a very important difference is that Fed may have to use interest rates more than they have used in the past to rein in this type of inflation that's caused by just money sitting in people's bank account, not excess lending.
So it's quite interesting, right? Some of the points you made there in terms of the excess spending versus excess lending. Totally agree with you on it. The one place I'll take you back to is cost of living. In the 70s, there were cost of living adjustments. That is not taking place right now. And that is one big difference because that showed up in wages. Another thing that you're seeing that is different was more inflation expectations. Inflation expectations were de-anchored in the 70s. Right now, if you look at inflation expectations in the market right now, it's pretty benign. Higher than what you've had pre-pandemic, but it's still less than 3%. So that tells you that inflation expectations are de-anchored, and that's why the Fed is staying aggressive. That is one element. Once you begin to have inflation expectations get de-anchored, then you see the consumer actually willing to pay for something at a higher price now because they don't want the price to be higher later. Then lastly, in my mind, I think central banks are more transparent right now than what you had in the 70s. 70s was more of a black box. A few people get in the room, FOMC, and make a decision. Now, the central banks are more transparent in terms of what they are thinking, and they're bringing in dot plots, economic projections, which allows the market to adjust. And I think that's why the market really trusts the Fed, ultimately, that this is going to get done and inflation is going to be curtailed. But the jury's out, and I think we're watching.
Great. Thanks very much, Olumide. And I want to pick up on something that, Raheel, your points about this huge amount of excess savings is so interesting at this time. Americans spent a record amount on Cyber Monday, apparently the most that they've spent ever, 11.3 billion, I think, on Cyber Monday. So there's this resilient spending, even as inflation continues to be so elevated and there's a potential recession around the corner. How do you see that changing in the coming months?
See, the issue is not the prices are high. Issue is that I am, as a consumer, I'm demanding everything and I have the capacity to pay for everything. That's why inflation is broad-based and high. It really is a tale of two Americas. If you're in the bottom 30 or bottom 20%, you're already in a recession. And we see these in companies catering to that segment of the population. It's misses and lowering guidance. And companies catering to the wealthy America, they are beating and raising guidance. There is a consumer in America who's never been in better shape. And there's a consumer in America who's never been in worse shape. So the Fed's objective in fighting this inflation is to reduce this divide to more like a historical norm. We're not saying that everybody is going to start having the same, spending and saving and investment patterns, but the divide has become so wide that it's unsustainable and unhealthy for a safe and prosperous economy. And that's the ultimate objective in bringing inflation down.
So, Ray, I always look at three major parts of the economy and say there are three drivers of it. One, food. How do you measure it? Food away from home. Begin to look at the prices and that number. It continues to go up. The second thing is gas prices. Gas prices, obviously, is come from the peaks that we saw early in the year, but it's still elevated. And the last part of it is mortgages. And when you look at all these three, they've been super elevated. And for the Fed, you want all of that to come down. Some you can control, others you cannot. So being able to navigate these policy measures in such a way that it affects all and not just a few, I think that's another challenge for the Fed. And I think we continue to see the Fed remain aggressive because of some of these issues. It's not balanced across the board, but if food price can come down and gasoline price can come down, obviously more geopolitical than anything else, I think that will be more acceptable and Fed will have done its job.
Great, thanks very much. Now, I believe most of the comments that we've heard so far have been from a US perspective, so I want to just take a moment to discuss inflation outside of the US. It's, of course, been elevated really around the world, from Europe all the way to Asia. One of our recent podcast episodes really focused on Japan, which has lower inflation levels than the US, but still elevated based on its historical levels. Olumide, why don't you share some thoughts on the current levels or your future expectations for key regions around the world?
This inflation phenomenon has been global in nature, without a doubt. And to your point, U.S. got a peak of around 9% in headline inflation. It's been higher when you go to Europe, 11%, 12%, and levels like that. And Europe, UK, and even emerging market economies. I think the key driver for those economies is being food and energy. U.S. being energy independent, there's been elevated oil prices, but the impact has been deeper when you look at those economies. Obviously, goods prices due to the pandemic has also been a big driver for those economies. We think going forward, the similar dynamics works out where the level of inflation reduces, but not necessarily going back to pre-pandemic levels. There are, in our minds, some structural changes that is going on in inflation. And I think for it to play out, it's going to take a lot longer than investors are expecting. And I think that is going to be a new regime. And going to be interesting how central banks and investors respond to it overall.
I'm just going to add one more thing to it. It's well known the dollar's been strengthening, and a strong dollar tends to be disinflationary in the US. It's hard to believe. Imagine if the dollar hadn't strengthened, there'd be even more inflation. But it also tends to be inflationary for the rest of the world, because as US dollar is strengthening, it's strengthening against global currencies, and their currencies are getting weaker, and so the imports are getting expensive. So there's that element also. As long as dollar continues to rise, the pressures will be on. At the other side, as dollar begins to weaken, you're going to get some respite in one of the inflation drivers for these international ex-US countries.
That's a very good point, Rahil. Thank you very much for bringing it up. Now, I want to turn to asset allocation implications for 2023. And I'll ask each of you, based on your base case for inflation, tell us what you think the impact is. Rahil, maybe you can get started with equities.
Yeah, I think the most important thing, maybe also not very well understood, is that the companies have been outstanding at converting inflation into earnings. If you look at earnings season and the company reports, margins have held steady. So whatever inflation they're getting on the cost side, they convert that into higher pricing power and pass it on to the next person. Sometimes it's the consumer. So if you're headed into a recession, why aren't earnings coming down? Well, they're not coming down because inflation is not coming down. I'm not saying this is the only driver, but this is a very important driver when it's growing at 5 to 8%, depending on what inflation you look at. That is a key input into earnings. So as inflation begins to come down and rate tightening begins to take impact, it is a reason to celebrate, but at the same time, earnings will be coming down with it. So for equity investors, one has to be mindful that falling earnings creates risk. So we are very cautious going forward. The other implications, higher inflation, PE ratios should be lower. So as inflation comes down, we think PE ratio will stabilize, earnings will come down. So in the next phase of the bear market will be an earnings-driven bear market, part of it because growth comes down, but an important part because inflation comes down. Inflation comes down, earnings come down.
All right, so an earnings-driven bear market is the view from Rahil on equities. Over to you, Olumide, for your view on fixed income markets.
So fixed income market, we think is going to be interesting going forward because you've seen a shift higher in rates across the board. And if you're an investor, you're looking at total return. And one of the things fixed income is going to provide is, one, a safe haven if at some point there's a recession or weaker demand. And two, you have higher income. So even if rates are going to move maybe slightly higher from where they are, they cannot go as high as what we've witnessed so far this year. So you have higher income while you buy bonds, and then the total return standpoint will be positive. So for us, we think there is going to be more demand for bonds overall. And I think lastly, majority of the central banks have already done what they need to do in terms of hiking rates. And you're getting into a policy era where there's going to be more stability, less volatility while inflation is rolling off. So we think it's going to be very attractive for fixed income securities.
Great. Now, as we start to wrap up today, I want to ask each of you for an aspect of this inflation picture that you think investors are overlooking. What are people not talking about that they need to be when it comes to inflation?
I think it's the changing face of inflation. Everybody's so worried about what has already happened rather than not focusing on what could happen. There are structural dynamics that are changing within inflation. I think there's a supply-demand imbalance that is going on in almost half of the measures of inflation. Food, energy, greenization of energy is going to be a big impact, which keeps energy prices a little bit higher. Folks are not talking about that. There is a transitory part of inflation, but the structural part of inflation, I think, has been neglected for now. And we think that is what keeps inflation a little bit higher, at least continues to bring the tail risk for inflation as we go further.
Rahil, what about you? What are investors overlooking?
I think people treat economic data the same way. And as students of business cycle, we classify data into leading, coincident, and lagging. That helps us sequence. So inflation in this classification, especially services inflation, is lagging in nature. First, interest rate hikes, it affects interest rate sensitive sectors. Housing is an example. Then the weakness slowly moves into retail sales, income, employment, and production. So only the leading parts of the economy have been hit by interest rate hikes. We haven't seen the weakness come yet to the coincident parts of the economy. Once you see weakness in coincident economy, then the weakness moves into the lagging part of the economy, such as inflation. What does it all mean? It means there's a durable sequence from leading to coincident to lagging. For inflation to begin to move down sustainably, we need to see first weakness in coincident economy, the economy that's defined by income, employment, production, and sales. We are not quite at that point. As Anu just mentioned, retail sales are very strong. In this environment, inflation will continue to remain elevated. I think with services inflation, which is really squarely aimed at the labor market, we need to see weakness in labor market before we start seeing weakness in services inflation that will satisfy the Fed.
Terrific. Thank you. Now, finally, I started off this episode with the famous saying, what goes up must come down. So I'm going to ask each of you if this law of physics holds as regards to inflation. My question is, when do you think we will see a reprieve? When do you think we're going to see peak inflation if we haven't already seen it yet? So maybe Olumide, what do you think?
I actually think over the next 2 years, we'll see peak inflation. What goes up must come down, I think is going to hold over the next 18 months. The question then becomes, where does it settle? We think the settlement level is going to be higher than where it started from pre-pandemic. After 2 years, though, there's a tail risk. And I think the risk here is, hopefully, we don't end up with a double peak. And I don't know, nobody wants to hear that. But I think even if that's going to happen, it's still going to take a long, long time before you get there. But definitely, I think that law is going to come to fruition when it's all said and done.
So I think the inflation peak, like I mentioned, there's a durable sequence. If you were to ask me to guess, it's kind of very hard to talk about business cycle peaks and troughs, especially in environments like these where there is very little analog available. But if we just look at what the trajectory of growth in employment is, I would say inflation probably peaks in the next 6 months. Market is acting like it has already peaked. I don't share that view. I think the peak in inflation that matters for Fed, which is sticky inflation, is probably going to happen in the next 6 months.
All right. And I can't let you both go without a quick bonus question. So as we head towards the end of the year, this is a time of a lot of families getting together and traditions. And so my question for each of you is, what is a tradition that's part of your lives now or one that you've enjoyed to celebrate in the past?
Interesting question. Tradition that has been turned around here for us as a family is the Thanksgiving celebration, where everybody in the family on both sides come together and we host Thanksgiving in the same household. So it's something we enjoy. And with the recent one, it's been very interesting, and adding that into the World Cup, being able to just wake up, watch football and not soccer. And, turn off there and have a lot of food. Already looking forward to next year, to be honest.
Great. How many people were around your Thanksgiving table this year?
72.
72? Wow. Okay, that's a lot of food, I imagine. Raheel, what about you?
Well, in my family, we've taken an American tradition and modified it.
Okay, go ahead.
So around Thanksgiving, and we do a tandoori turkey.
That sounds delicious. Go on, tell us more.
It's a spicier version of the American turkey. It has a spicy sauce to go with it. So we finally figured out how to perfect it. So.
All right, kick it up a notch. I like that. Excellent. Well, Olumide and Raheel, thank you very much for joining me today. As I said before, this topic on inflation is the most commonly discussed topic with investors right now. It's very topical. It's been terrific to get your insights, Olumide, from a fixed income perspective and Raheel from an equity perspective. Thank you again for joining me on the show.
Thanks for having us.
Thank you.
And to our listeners, if you've enjoyed what you've heard today on Disruptive Forces, you can subscribe to the show via Apple Podcast, Google Podcast, or Spotify, or you can visit our website, www.nb.com/disruptive forces, for previous episodes as well as more information about our firm and offerings.
This podcast contains general market commentary, general investment education, and general information about Neuberger Berman. It is for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. This communication is not directed at any investor or category of investors, and should not be regarded as investment advice or a suggestion to engage in or refrain from any investment-related course of action. All information is current as of the date of recording, and is subject to change without notice. Any views or opinions expressed may not reflect those of the firm as a whole. This material may include estimates, outlooks, projections, and other forward-looking statements. Due to a variety of factors, actual events or market behavior may differ significantly from any views expressed. Please refer to the disclosures contained in the episode notes and episode details, which are an important part of this communication. Investing entails risks, including the possible loss of principal. Past performance is no guarantee of future results.